If you're in your 30s, the most dangerous financial advice you will ever hear sounds completely reasonable, completely mature, and completely responsible. And that's exactly why it's so dangerous. It won't sound like a scam. It won't sound reckless. It won't even sound wrong. In fact, most people around you will repeat it with confidence. Your parents will nod at it. Your friends will justify it. Your colleagues will live by it. And if you follow it without thinking, you won't feel like you're making a mistake. You'll feel like you're growing up. But here's the truth no one says out loud. Your 30s are not the decade to settle down financially. They are the decade that either locks in your ceiling or explodes it. And in this video, I want to walk you through the subtle lie that quietly caps your wealth, shrinks your options, and trades long-term freedom for short-term comfort. Because once you see it clearly, you will never look at your financial decisions the same way again. When I look at people in their 30s, I don't see laziness. I don't see irresponsibility. I see pressure, real pressure. This is the decade where life gets serious. Careers accelerate. Relationships deepen. Maybe marriage. Maybe kids. Maybe property. Responsibilities grow. Expectations grow. And so does comparison. You look around and it feels like everyone is upgrading at the same time. Bigger apartments, nicer cars, engagement rings, international holidays, renovations, investment properties. And somewhere in that noise, a very calm, very logical voice starts whispering, "You've worked hard. It's time to enjoy it. You deserve to live a little. You can always invest more later." That voice is the most dangerous financial advice in your 30s. Not because enjoying your money is wrong, not because lifestyle upgrades are evil, but because of timing. Your 30s are mathematically explosive. They are the decade where compounding either becomes your ally or your enemy. Every dollar invested in your early 30s has dramatically more power than a dollar invested in your 40s or 50s. And yet, this is the exact decade most people dramatically increase their fixed costs. Think about that. Fixed costs, not experiences. Not one-off splurges. Fixed costs. The mortgage that stretches just a little too far. The car loan justified by, "I need something reliable." The private school decision made because we want the best. The subscription stack that quietly grows. The upgraded lifestyle that becomes the new normal. None of these decisions feel extreme on their own. That's what makes them powerful. They stack. And when they stack, they harden. I've realized something uncomfortable about my 30s. The danger isn't that I won't earn enough, it's that I'll earn more and immediately absorb it into a life that requires me to keep earning more. That's the trap. Income rises, but so does overhead. And once your overhead rises, your freedom shrinks. You don't feel poor, you feel successful, but you also feel locked in. And the advice that led you there sounded so mature. Buy the house you'll grow into. You can refinance later. Property always goes up. You don't want to miss out. This is just what people do in their 30s. What no one says is that every major upgrade reduces your margin. And margin is everything. Margin is the gap between what you earn and what you need. Margin is what allows you to invest aggressively. Margin is what allows you to take career risks. Margin is what allows you to say no. When your fixed costs are low relative to your income, you are anti-fragile. When your fixed costs are high, you are fragile. And your 30s are when that fragility quietly gets cemented. Here's what I've noticed. In your 20s, you feel behind but flexible. In your 30s, you feel established but exposed. You have more to lose. And because you have more to lose, you make safer decisions. You choose stability over asymmetry. You choose comfort over capacity. You choose what looks responsible over what builds leverage. The most dangerous advice in your 30s is this. Optimize for comfort now. You can optimize for wealth later. That sounds harmless. But later never feels like later. It feels like now. When you hit your 40s, responsibilities are even higher. When you hit your 50s, risk tolerance drops. The window of aggressive compounding was your 30s. This is the decade where your income is rising, but your timeline is still long. That combination is rare, and most people waste it trying to feel settled. I don't want to feel settled in my 30s. I want to feel building. There's a difference. Settled means fixed. Building means dynamic. Settled means optimized for today. Building means optimized for optionality. Optionality is the real wealth. It's not the car. It's not the kitchen. Renovation? It's not the second bathroom. It's the ability to pivot, the ability to walk away, the ability to reduce hours, the ability to take a sabbatical, the ability to invest when markets crash instead of panic selling because your mortgage is suffocating you. That's what most people misunderstand. High fixed costs don't just reduce savings. They reduce courage. When your lifestyle depends on your current income level, you can't take intelligent risks. You cling to stability. You tolerate work you hate. You avoid starting that business. You don't negotiate as hard. You don't relocate for opportunity. You become defensive. And defensive people rarely build extraordinary wealth. They protect what they have. That's rational. But it's limiting. Your 30s are not the decade to defend. They are the decade to expand intelligently. And expansion doesn't mean spending. It means investing. It means skill stacking. It means income leverage. It means equity exposure. It means asymmetric bets with controlled downside. That doesn't sound sexy. It sounds strategic. But strategy in your 30s compounds into freedom in your 40s. Let me paint two timelines. In timeline 1, you earn more every year and upgrade every year. You buy at the top of your borrowing capacity. You justify it because rates are manageable. You tell yourself you'll invest more when things calm down. Things don't calm down. You adapt to the new baseline. Promotions go toward repayments. Bonuses disappear into renovations. You feel busy, productive, adult. But your net worth growth is slower than your income growth. In timeline 2, you deliberately under-upgrade. You buy beneath your maximum capacity or delay buying. You keep fixed costs lean relative to income. You automate investing at uncomfortable levels. You channel raises into assets instead of liabilities. You still live well, but you protect margin like it's sacred. In the first 5 years, the difference feels small. In the next 10, it becomes dramatic. Because compounding does not reward intensity, it rewards consistency and time. And time is what your 30s still give you. Another dangerous layer of advice in your 30s is comparison-driven timing. Everyone else is doing it. If we don't buy now, we'll be priced out. We should have what our peers have. Social proof feels safe. But markets don't care about your social circle. The most expensive decisions I've seen weren't driven by greed. They were driven by belonging. People don't stretch because they want to show off. They stretch because they don't want to feel behind. But here's the paradox. The people who look most ahead in their 30s are often the most leveraged. High-income, low-margin lives. Impressive on the outside, tight on the inside. And tight lives make tight decisions. Wealth requires breathing room. The most powerful position in your 30s is not high income. It's high savings rate relative to fixed costs. That's the engine. That's the multiplier. Because when markets dip, you deploy. When opportunities appear, you act. When jobs become misaligned, you leave. That flexibility is priceless. And yet the cultural script pushes the opposite. Upgrade now, you've earned it. I'm not anti-enjoyment. I'm anti-permanent upgrades too early. Temporary enjoyment is cheap. Permanent overhead is expensive. There's also career risk. Your 30s often feel stable, but industries shift quickly. Technology changes, roles evolve, entire sectors compress. If your financial structure assumes uninterrupted income growth, you're exposed. The safest strategy long-term is actually aggressive investing early and conservative lifestyle inflation. It feels inverted, but it works. Because assets grow quietly while lifestyle expectations grow loudly. The loud growth feels rewarding. The quiet growth builds freedom. And freedom is what most people say they want. But their structure says otherwise. Let me ask you something uncomfortable. If your income stopped growing tomorrow, how long could you maintain your current lifestyle without stress? That answer reveals more about your financial strength than your salary ever will. High earners with no margin are fragile. Moderate earners with high margin are powerful. In your 30s, you're choosing which one you become. The dangerous advice says, maximize lifestyle while income is strong. The wiser path says, maximize asset ownership while time is strong. Because time is the rarest variable income can scale. Time cannot. And your 30s are still early enough for compounding to feel exponential later. There's also identity at play. In your 30s, you start seeing yourself as established. You want external proof. A house signals stability. A new car signals progress. A certain postcode signals arrival. These symbols are not inherently bad, but if they come at the expense of ownership and productive assets, they delay the very freedom they symbolize. I had to confront this personally. I realized I was more excited about looking successful than being financially unshakable. And those are not the same thing. Unshakable is quiet. It's liquidity. It's diversified assets. It's low dependency. It's optionality. It doesn't photograph well, but it feels powerful internally. The advice that nearly trapped me was simple. This is just the natural next step. But natural isn't always optimal. The natural path is lifestyle creep. The intentional path is controlled expansion. Controlled expansion means you increase lifestyle only after asset growth justifies it, not before. It means raises increase your investment rate first, not your repayment burden. It means bonuses buy assets, not status. It means your future self gets paid before your present self upgrades. That mindset shift changes everything. Because once assets begin compounding meaningfully, your risk profile changes. In your 40s, you can afford more lifestyle because your base is strong. In your 50s, you can downshift without panic, but only if your 30s were structurally aggressive. Most people reverse it. They're aggressive with lifestyle early and defensive with investments later. And that's the inversion that costs millions over decades. This is not about deprivation. It's about sequencing. Enjoyment is more powerful when it's funded by asset income instead of fragile cash flow. Security feels different when it's backed by equity growth instead of job continuity. Your 30s are the last decade where aggressive compounding feels normal. In your 20s, income is lower. In your 40s, obligations are higher. In your 30s, you sit in the sweet spot. Rising income, long runway. Don't trade that for granite countertops too early. I promise you, countertops will still exist in 10 years. But 10 years of compounding at scale will not magically reappear. If this resonates, it's not because you're irresponsible. It's because the cultural narrative is strong. We're taught milestones, not multipliers. We celebrate purchases, not positions. We applaud upgrades, not ownership ratios. But the people who quietly build wealth in their 30s often look boring at first. Then a decade later, they look free. And freedom ages well. So here's the reframe I hold on to. In my 30s, I'm not trying to look established. I'm trying to become unshakable. I'm not trying to maximize comfort. I'm trying to maximize optionality. I'm not trying to keep up. I'm trying to compound. And when I zoom out to 50 or 60, I know which version of me I'll thank. The one who bought bigger too soon, or the one who built wider first. The most dangerous financial advice in your 30s is not reckless. It's reasonable. It's socially approved. It's incremental. And that's exactly why you have to question it. Because in this decade, small structural decisions echo for the rest of your life. Choose expansion over appearance. Choose assets over upgrades. Choose margin over maximum borrowing capacity. Choose building over settling. Your 30s are not where you lock in comfort. They are where you lock in trajectory. And trajectory, once set, compounds quietly into everything. And if you're still with me, I want to go deeper because the real danger in your 30s isn't just financial, it's psychological. It's the story you start telling yourself about what's normal. Normal debt levels, normal stress, normal lifestyle inflation, normal exhaustion, normal upgrades. The problem with normal is that it's invisible. You don't feel reckless. You feel aligned. You feel like you're finally doing what adults are supposed to do. And that subtle shift in identity is powerful. Because once you identify as someone who has a big mortgage, or has expensive obligations, or needs this income level, you begin protecting that identity. You defend it. You justify it. You build your decisions around maintaining it. And over time, your financial life stops being about growth and starts being about maintenance. That is the silent pivot that happens in so many 30s. You move from builder to maintainer without realizing it. And builders think differently. Builders tolerate temporary imbalance for long-term leverage. Maintainers optimize for predictability. Builders focus on upside. Maintainers focus on downside. Neither is wrong. But timing matters. In your 30s, you still have the energy, the runway, and the income growth potential to act like a builder. And yet most people prematurely switch into maintainer mode because their structure forces them to. I've had to ask myself a hard question. Am I making this decision because it increases my future options or because it reduces my present discomfort? Those are not the same thing. Present discomfort might be renting while friends buy. It might be driving the same car for longer. It might be saying no to an upgrade you technically qualify for. But qualifying for something does not mean it qualifies for you. Banks approve based on repayment capacity. They do not optimize for your freedom. And that's a distinction that becomes painfully clear later. Another layer of dangerous advice in your 30s is the idea that stability equals safety. It sounds wise. Lock in the job. Lock in the house. Lock in the rate. Lock in the path. But locking in too early can also mean locking out optionality. The world changes quickly. Industries compress. Opportunities appear in unexpected places. If your financial commitments require you to stay exactly where you are, doing exactly what you're doing, for the next 20 years, that's not safety. That's dependency. True safety is flexibility. It's knowing you could pivot without collapse. It's having enough invested that your job is important, but not existential. It's having enough margin that a market dip feels like opportunity, not threat. And margin is built quietly through deliberate underconsumption relative to income. That phrase sounds extreme, but it's simply this: earn more than you need and invest the difference aggressively. Not casually, aggressively. Your 30s are the last decade where aggressive still feels rational. By your 40s, you'll want predictability. By your 50s, you'll want preservation. So if you delay the aggression, you compress the runway. And compression creates pressure. Pressure creates fear. Fear creates conservative decisions. And conservative decisions, made too late, don't catch up to lost time easily. There's also something no one talks about. Lifestyle resets upward much faster than it resets downward. When you upgrade, it feels permanent. You adapt quickly. The new normal becomes invisible. But if you ever have to downgrade, the emotional resistance is intense. That's why keeping your baseline intentionally lean in your 30s is powerful. Because upward adjustments are always easier than downward corrections. And financial resilience is about protecting against forced corrections. I think about this in terms of trajectory versus snapshot. A snapshot shows your house, your car, your holidays. Trajectory shows your net worth curve, your savings rate, your equity ownership. Snapshots impress today. Trajectory determines tomorrow. And most dangerous advice in your 30s is snapshot-driven. You should be here by now. You should have this by now. At your age, you should own. Those statements are emotionally loaded, but they ignore math. They ignore compounding. They ignore opportunity cost. They ignore the fact that every dollar tied into consumption is a dollar not multiplying. When I zoom out 30 years, I don't remember the year I drove a slightly nicer car. But I absolutely feel the difference between having assets that throw off income and assets that require income. That's the structural divide. Assets that produce versus assets that consume. Your 30s are when that ratio gets set. And once it's set, it compounds in either direction. So here's the reframe that guides me now. In my 30s, I want my lifestyle growth to lag my asset growth. Not the other way around. I want to feel slightly ahead of my obligations, not perfectly matched to them. I want my raises to create space, not tension. I want my investments to quietly outpace my upgrades. Because a decade of that imbalance in your favor becomes unstoppable momentum. And momentum is what creates calm later. People think financial calm comes from earning more. It rarely does. It comes from needing less relative to what you earn and owning more relative to what you owe. That ratio is the real metric. Not salary, not postcode, not car brand. Ratio. If you're in your 30s right now, you're not behind. You're not late. You're not failing. But you are in a pivotal window. The decisions that feel small today are structural. The advice that sounds responsible may be restrictive. The upgrades that feel deserved may be expensive in ways you won't notice until much later. So question the narrative. Protect your margin. Expand your assets before your lifestyle. Build first, display later. Because your 30s are not just another decade. They are the hinge. And hinges are small, but they swing entire doors.